Okay, the next area we're going to discuss is what's known as the luxury auto limitation. This is section 280F of the tax code. And basically, Congress is just limiting the amount of depreciation you can deduct against a business auto. That's kind of it, period. So it's limited to a certain amount each year. The amount that it's limited to depends on when it was placed in service for the first year. So you can see that if you place it in service in 2022, your first year limit is 11,200. If you elect bonus depreciation, you're eligible to add 8,000 to that first year amount. So again, if you don't elect out of bonus depreciation, it would be 19,200. And you can see there's prior amounts for 2021 and 2020 because these limitations are adjusted each year for inflation. So Luke, Han, and Yoda place in service the following autos. So Luke's is for 10, Han's for 25, Yoda's for 70,000. They all have 100% business use. Assume all half-year and 5-year lives. So an auto typically has a 5-year life. So really all we're assuming is half-year. And we're not electing bonus, right? Bonus count. The bonus election complicates the depreciation for autos. Okay, so the cost 10, 25, and 70. The business use is 100%, so we multiply it by 20%. That's the depreciation factor for 5-year property for first year. And the actual, what we describe as actual depreciation, will be 2,000, 5,000, or 14,000. However, the limit is 11,200. And so what would happen is the deduction amount for the first two autos, because the actual is less than the limit, would be the actual, so 2,000, 5,000. However, for Yoda's car, because the actual exceeds the limit of 11,200, 11,200 is the amount of depreciation you would deduct. So what if Yoda only used the car 60% for business? Well, then you take the 70,000 multiplied by 60%, multiply that by 0.2, you get actual depreciation of 8,400. And you'd say to yourself, oh, great, that's below the threshold. He can deduct 8,400. However, that would be wrong. Whatever proration you apply to represent business use, for actual depreciation, you must also apply to the limit. So we take the limit of 11,200 multiplied by the same 60%. And we'd see that his limit is 6,720, and so Yoda would only be able to take 6,720 on the year. All right, what if they chose bonus? Well, you can see that now the limit goes up by 8,000. So you would write off the entire cost of the $10,000 car. That's below the limit. You're going to be fine. For Han, the car costs 25,000. You can deduct 19,200 of that, but the rest of it you're going to have to depreciate. And with Yoda, you could write off 19,200 and the rest you'll have to depreciate. There is a special rule for sport utility vehicles that have a gross weight over 6,000 pounds. They can take section 179 up to a limit of 27,000. So if that exceeds the actual amount, which it does 19,200, then they could take 179 and deduct up to 27,000. But that is only for vehicles with a gross weight over 6,000 pounds. So this is basically to favor big trucks and SUVs in the United States because they're manufactured here. Okay, so in case you haven't gathered this partial business use, I introduced that with the autos. Let's say I have a $1,000 5-year asset. It's used 55% for business, 30% for the production of income, and 15% for personal use. So let's say it's an auto, for example. Now, how I'd buy a $1,000 auto is beyond me, but that's something you could use in all these, right? So what you basically do is break the asset down, and it's like treating each part as an individual asset. So first you'd compute cost recovery, assuming maximum 179. Well, only the portion used in a trade or business is eligible for Section 179. Recall that production of income is not. So the $550 would be deducted under 179. The next amount is the $300 that's used for production of income. That's eligible for makers. And again, we're assuming no bonus depreciation. So if we deduct the maker's part, that's a 5-year property times 0.2, we get $60 worth of makers. And of course, that portion that's used for personal use is not depreciable at all. All right. Yeah, let's keep going and keep doing amortization. In fact, let's just finish out the video. There's only a couple areas. It's amortization and depletion is all that's left. So amortization is for intangible assets. This is how businesses recover the cost of those. And they really come in two forms. So a lot of times we think of them as being either a Section 197 intangible. We covered startup expenditures and org costs. We talked about research and experimentation costs. We haven't talked about patents and copyrights. So it's really just the first one and the fourth one here that we've not discussed previously. So what's the Section 197 intangible? That's one that is, that's when you acquire an intangible as part of the acquisition of another business. So this is not the acquisition of the individual intangible itself, but rather the acquisition of a business. And when you acquire that business, it comes with some intangibles. So all 197 intangibles have a recovery period of 15 years, 180 months. So it's just like org costs. And it's irrespective of their actual life. Section 197 intangibles, like our other intangibles, use the full month convention. You deduct an entire month's worth in the month of purchase. And let's assume that Greta purchases a business for $1 million, allocates cost as follows, right? So you typically, we don't need to get into purchase accounting, but you do it based on fair market values. So land gets $200,000, the factory gets $400,000, a patent gets $100,000, and what's left over is just assigned to goodwill, and there's her $1 million worth of purchase price. So now we need to establish what of these are 197 intangibles. And recall that's any intangible you acquire as part of the acquisition of a business. So in this case, both the patent and goodwill would need to be amortized over 15 years. All right. But what if you acquire a patent and a copyright separately? In this case, you amortize it over the remaining life of the patent or the copyright. And again, if it's part of a business acquisition, it's a 197 intangible. That's really it, right? So let's say you bought a 2-year, or let's say you bought a patent for $100,000, and the patent has a 2-year remaining life. You would amortize half of the cost in year 1 and half of the cost in year 2, and then you're done. The last area is depletion. And depletion, again, is the cost recovery that's associated with natural resources. So let's assume that Judge Smales recently purchased a small tract of land, and he bought it for $100 million because he knew there was copper under the land. And so what he does is he immediately starts mining the land and extracting copper from the ore. And he sells the ore and, of course, makes money. So as he's selling off the copper, he paid $100 million for the land, so how does he recognize the cost? Because remember that land is a non-depreciable asset. But there was copper in the ground, and so this is where depletion comes from. It's the method of recovering an investment in an exhaustible natural resource. There are two methods. Cost depletion, which I think we're going to find makes perfect sense, and percentage depletion, which kind of makes no sense at all. So cost depletion operates just like units of production depreciation. And yeah, I don't expect you to remember how to do units of production, but you will need to be able to do depletion, cost depletion. So Judge Smales is estimated to have 60,000 tons of copper, and he mines 15,000 tons in the first year, and 10,000 of those tons were sold. So how much does he recover? Well, you say, okay, he's sold 10,000 out of the 60,000 he estimated to be in there. That's 1/6 times the amount he purchased the land for, which is $100 million. So his depletion would be 16,666,667. Percentage depletion works very differently. Basically, there are just statutory rates. So the Congress has written rates, and it says, okay, for copper, the depletion rate is 15%. So in this case, you take the gross income and you simply multiply it by the percentage depletion rate. So when Judge Smales sold all those 10,000 tons of copper, he made $20 million. So you take the 20 million multiplied by the 15% rate that's associated with copper, you get $3 million. you are eligible to take the greater of the two, either the greater of your cost versus your depletion. In this particular case, the cost depletion is much, much higher. It's almost 17 million versus 3 million. And note that percent depletion is limited to 50% of your taxable income. So remember how 179 was basically limited to 100% of your taxable income before 179? Depletion is limited to 50% of your taxable income before depletion. However, that's bumped up to 100% for gas and oil because Congress has for years loved gas and oil. That brings us to the end. Thanks for watching. See you in class.